right? You're over $100,000 in income a year
Just by doing one deal.
just by doing one deal.
Basically, you've got a way to make a living on just one deal.
All right, guys, welcome back to How to Invest in Commercial Real Estate. This is episode 15, and we've done a lot of explaining on how commercial real estate can make you tons of money and you can invest in it. It's the best asset class, but today we're really going to supersize that and jumpstart it and go into how you can make tons of money as a sponsor, sponsoring deals and buying these commercial real estate deals yourself.
Yeah, absolutely. Syndication is another term. I would say Precision Equity, we're a syndicator of commercial real estate, and it is. We buy for ourselves, but you can really juice the returns if you become a syndicator because of some of the fees that you can get.
Yeah, so let's just break down that word really quick. A syndication is when a sponsor, somebody like Criterion or somebody like Precision Equity is going out and finding a deal. They're finding the debt. They're finding, everything about the investment. They put it together. They send it out to a group of investors. That's a key to a syndication is you're partnering with a group of people. And then they review it. They decide it's a great deal. They partner with you on it. And then that's a syndication. So, Criterion or Precision would be the general partner, would, make sure the deal's running smooth. But anyway, that generally speaking is syndication. So you can buy deals by yourself, not have investors and just cash flow it, or you can syndicate it. And then you can leverage, you're not only providing an amazing opportunity to your investors, but you're leveraging that and making money as well.
Yeah, definitely.
So I think the best way to get into this is to probably just start with a deal, right? So we've got this deal we're going to buy. It's a syndication. We've acknowledged the fact that we're going to do a syndication. So what are some of the different ways that us as a sponsor are getting paid doing the syndication? How is it done?
Yeah. So the $5 million deal, you're going to raise $1 million, $1.1 million for some extra expenses is going to be the down payment. And you can make, if I'm going to buy it, I can make my 15% cash on cash on that $1 million or $1.1 million.
Right.
Okay. But how do you make even more money and benefit people that and that's the syndication. So let's walk through a few of the fees. The first one that you can think about is if you have your broker's license, which you can get in about 2 to 3 years, is you can get a broker's commission for the buy side.
Yeah. I don't even think it's 2 to 3 years. It's super easy, but yeah.
Well, and what kind of percentage or what kind of fee does that garner?
Yeah, so on a commercial deal, a normal co-broke is 1.5 to 3 to 4%. I would say.
I would say 1 to 3 would be typically 1.5% is what I've seen.
And that's just on the buy side.
That's just on the buy side. The typical commission on a $5 million deal. I mean, it could be as low as 2%, and it could be as high as 4 or 5%. And so typically they're either going to split it with you or they're going to give you a little less than half.
Okay. Right.
And so on this deal, let's say you get 1.5 points, which is pretty standard on a $5 million deal. $75,000 you can get for just buying a deal that you were already going to buy.
Boom, 75 grand.
Awesome. And you get that money when the property closes. Is that right?
That's right.
Right.
Okay.
Yeah, most of this is paid at closing. There's some that's paid, while you own the deal. If you're going to go buy this deal, you'll probably own it for 5, 7, 10 years. So there's some that'll be paid out residually over the ownership period, but we're going to focus on the fees paid at closing right now.
Okay.
The co-broke is a big one because in order to get that, you had to have found the deal, which is an important thing. But finding the deal can get you a $75,000 fee on that $5 million property. So if some other broker brings you that deal, they're going to keep that fee. But if you can find it yourself, you get that fee, and that's a lot of money.
Okay.
And it's not a guarantee. Sometimes commercial brokers don't cooperate, or they didn't get a big fee and they're saying they're not going to offer one. So it's not a guarantee, but sometimes you can get it.
Yeah, the next one is a big one. It's the acquisition fee. So acquisition fees, I would say, range from 1 to 2% of the initial purchase price of the deal. And what that is doing is that is reimbursing your due diligence costs, that you've kind of spent researching the deal,
Looking for deals, evaluating deals,
testing them, marketing them, putting them together, legal fees, everything like that.
So this
and
is
your
kind
time.
so this is kind of a fee for everything up to the point of closing, maybe.
Right.
Is that fair to say?
Yeah, because that deal could easily fall through. I mean, you could be researching a deal, you could have it in contract, and then it just doesn't work. You drop it, you lose that money.
Yeah.
But if you get it to closing, if it is a great deal, you're going to bill that partnership, that property, your acquisition fee, and that covers your time and expenses up until that point, getting that deal done.
Okay.
I want to add is that you're also going to be charging the expenses to the partnership. So you're not really reimbursing some of those expenses. Let's say I had some legal expenses in drafting the operating agreement or whatever, that I'm going to also bill.
Right.
But on all the deals that I didn't buy, I have expenses. Maybe I traveled to Colorado and looked at a deal and it didn't work, and I spent time and money on underwriting on this deal in Florida and it didn't work. And so you do need this fee to kind of help cover some of the ones that you're not going to buy. But it's 50 on this deal, 1 to 2 points. It's $50,000 to $100,000 of upfront cash that you can make by getting the deal.
Okay.
Nice. Yeah. And I would say, generally speaking, if you're a company looking at a ton of deals, you may spend more on due diligence and finding these deals, like you said, than you actually make back in acquisition fees, just because you're looking at so many. So you gotta pay attention to that, right? There's tons more ways you can get paid. So the debt, that's a big one. Somebody has got to go get the debt. Wow, that was a lot to get out.
Yeah, the debt, most sponsors and syndicators focus on non-recourse debt. And what that is, we haven't gone into debt a lot, but it's just if the deal goes south, as long as you were upfront and honest with all of the information.
You didn't commit fraud.
Then you're not going to be held liable for any shortfall on that loan. You can kind of just walk away and the lender takes back the asset as payment. And that's different.
Non-recourse.
Yeah,
right?
There is no recourse. Now, different from like, let's say your house. Let's say that you don't pay your house, you're personally signed on that. Well, the bank may take it back, but if the bank doesn't sell it for more than the loan balance, they can come after you for the difference.
They sue the shit out of you.
Yeah, and it's not a huge deal on a single family home, but it can be a massive deal if they say you have a $4 million loan on this $5 million deal we're talking about, and the market turns and they end up taking it back, and commercial doesn't have as many buyers, and so they end up selling it for $2.5–3 million. Well, now they'll come after you for that $1 million or $1.5 million. So it can be a huge thing to guarantee the debt. Yeah. Now, why would a syndicator do that? Well, in our position, we've done it several times because sometimes by getting local bank debt and personally guaranteeing it, you can get better terms, which results in higher returns for your investors.
Yeah. Now, why would you get better returns, right? Like if I'm a bank and I'm saying, okay, option A is a non-recourse loan. This guy's coming to me with a $5 million deal. And if that deal doesn't work, I don't get to sue that guy. That's it. I just get the property. I just get the tenants that are in there. I just get the income that it produced at the time. But option B is this guy who's worth $10 million. So he's got, you're only getting a $4 million loan, but this guy's worth $10 million. So if the property doesn't work out, you not only get the property, you not only get the tenants and the income that's in the property, but you get to sue the crap out of that guy.
Yeah. And in our case, Vic and I both have high net worths now. And so, yeah, there's a benefit for us signing because it gives them more assets to go after in the event that this deal, which is only, let's say, a $4 million loan doesn't work. Well, they can go after, 30, 40, $50 million of net worth that we have backing it.
And so this debt guarantee fee sort of pays a little bit for the liability, the extra liability that you've encountered. And then also because you've gone out and due to the extra liability, you're actually increasing the returns for your investors because you're getting a better interest rate. Is that right?
Yeah, and it's not always that we charge it. Sometimes we do get non-recourse debt. Fannie Freddie is an example where they give great non-recourse debt. And it's better than, let's say, the banks would give.
Yeah, most of those are on apartments.
Yeah, apartments. But on a lot of retail deals, we can get an 80%, let's say 80 to 85 even percent LTV on the debt, which will increase the rate of return on the equity placed.
Right.
And so that's that. If we went non-recourse, maybe I could get 70% LTV. Well, now I've got to raise a lot more equity, and I'm going to get a lower return on that equity. And so we charge the fee just to kind of compensate both our risk and taking that additional risk on, but also because we're providing higher returns.
And what's that typical fee?
1 to 2%. We've never taken any more than one, I don't think.
Purchase price or of the
loan amount?
Of the loan amount.
Yeah, good question.
Okay.
That was a really good question.
Okay.
Yeah, so I mean, just between those three, you've got a debt guarantee fee for taking on full recourse personal debt. And the investors are getting no no risk to the debt. When an investor signs up with us, we default on the debt for some reason, the bank doesn't care about the investor. The investor just walks away. So there's a fee in exchange for that risk.
Well, they could lose their investment,
yeah.
But no further recourse.
Correct. You've got the acquisition fee to reimburse you for your time and effort to get that deal closed. And then you've got the co-broke fee for being a broker or a realtor. Just those 3 fees right there are $165,000 just at closing.
On one $5 million acquisition.
Wow. Just one.
Dang.
But let's go into it, because that's not all the money you can make as a syndicator. Let's go into a few more.
Yeah, because you're going to own it, right? It's not like you just buy it and it makes you millions of dollars, makes your investors millions of dollars. You know, this is you've got to hold it. You've got to wait a little bit. It's like diamonds, pressure and time. You know what I mean? So after we get into this, somebody's got to manage it month over month. Somebody's got to call the tenants and collect the rent and everything like that. In Brian and I's case, Brian and I decided, man, we don't want to be property managers. We're in acquisition mode. We want to buy deals and we want to focus on what we're good at. Yep. So you can find management companies everywhere. Joel's got a management company.
Yeah. So on the management side, there's a couple different fees. Asset management fee is not a property management fee. It's 1% typically 1% of the annual revenue of the property that you take as the sponsor. And that just means that, yeah, there may be a management company, but who's picking them, who's managing them day to day, who's going over the numbers, who's trying to get lower tax bills and applying for insurance and making sure those costs are the lowest. Mm-hmm. Just managing the asset to its full potential, it's 1% every year of the revenue. In this case, it's probably only about $5,000, but it's about $500 a month in an asset management fee.
Yeah. I mean, you're not going to get rich off the asset management fee. It's really a formality, but somebody's got to manage that month over month. And then, the biggest difference between an asset management fee and a property management fee is a property management fee requires, a lot of experience and infrastructure and staff and time, and that's why they're typically reimbursed more. A property management company may get 3 to 4% of revenue, maybe more sometimes. One of the other big ones are leasing commissions. So in retail centers, industrial centers, several of the asset classes, you're dealing with tenants who sign really long-term expensive leases, 3, 5, 10-year leases. They may be millions of dollars in total and have all sorts of levels of guarantees. Traditionally speaking, those tenants and those landlords have real estate brokers or people with a real estate license. You don't have to have a real estate license, but they sometimes have them representing them. If you are smart enough and educated enough and you know the lease renewals you can get, you can negotiate those as an owner and take the standard market fee.
Which is what?
Well, it depends. On a renewal, you're going to look from 1 to 3%, 1% being super low end, super low end, 3% being closer to standard. And then if you're writing a new lease, the total commission is going to be about 6%. So you can split that between landlord and tenant. If there's 2 reps on either side, if there's just one, you can get all of it. But generally speaking, a lot of people who are brokering leases, they've got to go find these tenants or landlords and get all this property. But if you own the property, you can just lease it yourself and keep those fees.
And these are one-time fees that happen whenever you renew the lease or when you get a new lease. Is that right?
Absolutely. Yeah. So, we've got several retail centers and we've got several tenants in those retail centers with expiring leases. So you reach out to them and you say, hey, how's your business going? Do you want to stay? Of course they do. Their business is going great. We own great shopping centers. Why would they ever want to leave? And we say, okay, here's your renewal. It's for 3, 5, 10 years. We're thinking, 2% the first year increase, 3% second year increase. We'll give you a free month rent, whatever it is. And then we sign that lease. You may even charge for the document prep, right? Like somebody's got to prepare that lease amendment. If you're not hiring an attorney, if you already own that document, maybe that's a $500 document. And then you get it signed and boom, 3% fee of the total lease value.
I see.
So the total lease value of for 5 years, the total rent paid, that's what you're getting the 3% on. Yeah.
So if they're paying $5,000 a month for 60 months or 5 years, you do $5,000 a month times the 60 months, and that's going to be, whatever hundreds of thousands.
300,000?
Sure.
Yeah. 300,000 times 3% is $9,000.
Boom.
So that's a great way. And who's paying that fee?
The property is.
The property's paying the fee. So when you may be listening thinking, well, man, these guys are getting all these fees. The property's paying the fee. And so the investors, they can say, well, I'm kind of paying it. Yeah, it is coming out of the revenue of the property, but we're still generating above market returns for the investors, even with this built-in infrastructure. So we're always, we don't fee a deal to death at the expense of the investors where they're going to make 5% cash on cash. No, they're still going to be 12% cash on cash and maybe 18% IRR. So it's a good system for everybody.
Yeah.
Yeah, and this, this example we've been working off of, this $5 million deal, just the deal by itself, if you were to buy it yourself and not syndicate it, it would make you about 15% a year cash on cash with the debt and everything we've modeled up and scenario that we've been talking about. But because you're syndicating that, you know that you could go raise that $1 million, and there's a ton of people out there that would be ecstatic for 12% cash on cash. So you can leverage yourself and you can say, hey, instead of buying this $5 million property by yourself, I'm going to go buy a few of these with a bunch of my, friends, family, investor networks, capital. And then in exchange for getting them that amazing return of 12%, because 12% is an amazing return, comparatively speaking, to a lot of other investment classes. That's what the show's about. Commercial real estate makes more money. But you can go out and learn how to buy commercial real estate and manage other people's money through commercial real estate. And that's what this is about, because you're making fees and cash flow splits on the deal, like we've been talking about. You got $165,000 at closing just on this deal.
Yeah, and we have the $5,000 a year in asset management. Then we talked about the renewal commission. So on a deal like this, I would say roughly you could make $20,000 on just renewal commissions. So let's say you hire an outside brokerage to do new leases for you for the vacant space. They're out finding new tenants, but you have a tenant that is at your center that already wants to stay.
Yeah.
$20,000 a year potentially in renewal commissions.
Nice. Yeah. And why would somebody pay a broker to keep a tenant that already wants to stay? Hey, tenant, your lease is expiring. Do you want to stay? Yes.
People do it all the time.
You're only negotiating the rate. And as an owner, you should feel confident negotiating that rate.
Well, you want to negotiate the rate anyway. Even if you have a broker, you're going to be working with him. You might as well.
Now, if somebody wants to use Precision Equity to manage, I'm going to fight to be their renewal broker.
Yeah.
Because I'm going to know better what the market rent is and how to push them up in rent. So I'll argue that I can get my fee paid for by getting you better leases and better terms with your tenants.
Right.
But if you're a professional real estate investor and syndicating, you may have that experience to do yourself. That's why you don't have to outsource it.
Yeah.
But okay, so let's talk then. We've already got about $25,000 a year coming in income on this $5 million property.
Yeah.
Next is the cash flow. Yeah. So this deal is a 15% cash on cash deal. We've already talked about it. We have those in our portfolio or even higher. So these are not deals that are unattainable. But now we're going to pay an 8% preferred return to the investor. We talked about the waterfall in the last show.
Yeah.
And then we're going to split what's left 60-40, 60% to the investor. That leaves us 40% of what's left. And in this case, that's about $31,000 in cash flow a year.
Mm-hmm. Right.
And that's after getting the investors their 12%.
Yeah.
So there are deals out there where you can get all the fees you need and you can get your investors the returns they want, and there's still leftover cash flow for you, the sponsor. And so on this deal, that's $31,000. Which is amazing. And it doesn't even end there.
Yeah.
But wait, that's not all.
Yeah, but wait, there's more.
With this order, we throw in free shipping and handling, or whatever it is.
Well, so what's the next, Brian? What's the next way you can earn money?
Well, if you're investing on your deal yourself, that's the way you can earn it.
Yep.
And investors are going to want to see that, right? They don't want you pitching something to them and then you say, well, are you investing in this? No, I'm not. They're going to wonder why you're not. So it gives them confidence. They want you to have skin in the game. Every investor we talk to brings that up every time, right? So
and how much do we typically invest in our deals?
Well, we invest probably 30% or so in our deals.
So maybe a little bit more than you have to, but
yeah, I'd say if you were investing at least 10%, then that would give investors enough confidence to know that you've got enough skin in the game that you're going to do everything you can to make this project successful.
Yeah, so 10% of the 1.1 we're raising, you're investing, or your partnership, the sponsor is investing 110,000, and
right.
You're getting, the limited partners are getting 12 plus % on that. So that $110,000 is paying you an extra $13,000 a year just from being invested in your own deal.
Right.
I think a great thing to do would be, if you don't have to have the cash that you made up front, is invest that money in your own deal. So now you don't lose the $165,000 that you made when you bought it from the broker fee and acquisitions fee. You keep that, invest it. Now you're getting paid 12% on $160,000. Now you're looking at another $18,000, $20,000 in cash flow a year, and you didn't lose the money. It's in your deal.
Right.
Yeah.
And it's bought you ownership. You purchase the ownership, and then you get to take advantage of the depreciation that comes along with that. So that's another way.
Yeah.
But another one I was thinking of is, you got a $4 million loan. and you're paying that loan down every month. So what's your share of that equity buildup that you're getting? Because that's real. It's not cash flow in your pocket, but it is money that you're building on your net worth, and you're going to get that whenever you refinance or sell. And on this particular deal, it's a big number. I think it's $38,000. Can't remember.
Yeah. Just the sponsor's portion of debt, the 40% of the debt pay down is $40,000 a year.
$40,000 a year. So then you begin to see $40,000 a year plus $20,000 a year in maybe renewal commissions, plus $31,000 in cash flow, plus $5,000 in asset management fee. And if you invested that $165,000 from the beginning, you're getting 12%. That's another $18,000. Right? You're over $100,000 in income a year
just by doing one deal.
Just by doing one deal.
Basically, you've got a way to make a living on just one deal.
Yeah, a quick hack on your co-invest, using your fees to invest that back into the deal. That also doesn't generate a taxable event, right? So you're not getting taxed on the fees from the partnership because you're just taking it as discounted equity. So, another just little tidbit there.
Yeah, you'd have to make sure you did it right.
Yeah, we're not a CPA.
Yeah.
Consult your person.
But yeah, there's a chance to do some of that as well.
Absolutely. And this is off of one $5 million deal. It's off of one. How many deals you closed last year, Joel?
Oh, 3. Well,
I
3
think
or 4.
Yeah, I think we only did two or 3. One we closed at the beginning. Yeah, so 3.
But think about. I want to encourage people. They're working a job. They may be making $50,000. They may be making $100,000. I know there's guys that are making several $100,000. But okay, let's talk about the guys that are making $100,000 a year.
Yeah,
they work all year, every day, 9 hours a day to make that money. And this is something that you should start to try to work on right now. Now, are you going to become an expert to the point where you can buy a $5 million deal and syndicate it next month or next year? No. Okay. But it's worth the time to invest, because 5 years from now, you could be in that spot. And what if, 5 years from now, you could automatically make over $100,000 on the close and get yourself $100,000 a year in passive income that you never have to work for again. Okay. So what would you work? What would you do? How much time would you put in order to make that happen in 5 years? And then it gets better, because you could buy the same deal the next year.
Yeah.
So now it's not $100,000 a year in passive income, it's $200,000. And then the next one, now you're at $300,000. One deal a year when you're in this game, when you've been in it for 5 years, let's say, educating yourself, that is 100% possible. Okay, but then open your mind and say, well, okay, what if I bought a $10 million deal?
Whoa.
Now you're going to double all these numbers.
Yeah.
You could literally retire off of one $10 million syndication. And once again, you're not going to be able to do that in a year or two. You need to become an expert at this. You need to read, study, get in the game, start working on your broker's license, all these things. But I'm telling you, in 5 years or 10 years time, you could be in a position. So I'll flip it around. At your job, how much passive income can you generate if you spent the next 5 years at your job working 9 hours a day?
If just that job, it's not any, right?
Yeah, maybe you're making 20% more than you are today, and you still have to be working.
Yeah.
So what the point I'm trying to get to encourage people is they spend all day working at a job that's not going to change their income, and this is something that if they'll just work part-time for an extended period of time, they could set themselves up to quit that job and have money coming in from their syndication for the rest of their life.
Yeah.
And you build on that passive income, right? Every deal you buy after that just builds it. And really, once they're able to quit that day job, how many could they syndicate?
Oh, so much more.
Well,
That's why Brian and I don't manage deals, is so we can focus on those higher money making activities, right? So it's that same thing. Like, we could have a job and start a management company that doesn't really make much money.
Yeah. Or
we could go quit that job, hire somebody else to do it.
But sorry, go ahead.
Well, all I was going to say, like you were saying, it may take 2 or 3 or 4 years to get to the knowledge to get to that first deal. But once you do that first one, I mean, you're off and running as far as I'm concerned. You're going to learn a ton on that first deal. You'll learn a ton on the first few deals, but you'll be a lot quicker to pull the trigger on that second deal than you did on the first one. And then after that, you just do them as quick as you can.
Same thing with our investors, by the way.
Yeah,
Even
why
when
I'm
you're
so
investing limited.
I'm so passionate about it is because this is the scenario that I was in. I was making 48 grand a year when I started this process of learning. I wasn't even learning commercial real estate. I was learning residential real estate, trying to make an extra $1,000 or $2,000 a month in passive cash flow. Mm-hmm. Okay, but we're helping you skip that step. Yeah. But for me, it was I was in it for the long game, and I was not trying to get rich quick, and I was not trying to quit my job year one. What I was trying to do was build my knowledge and build passive income to the point where I could quit. And it took me a lot longer than it's going to take people listening to this podcast, because I just started from scratch and we just didn't know what I didn't know.
You didn't have this podcast.
Yeah, I didn't have this podcast, and the internet was just getting started back when I first started working.
You're showing your age, man.
I know. Well, my face shows my age, I think. But
that's true.
But anyway, this is something that people can do. That's why we want to get them excited about it. And we're going to continue to deliver tools on this show, and then through courses and things that we're going to deliver that will help people make that transition over a several year period, and it'll change their life.
Yeah, it will.
Well, I think this was a fantastic episode. Make sure you guys are tuning in. Make sure you subscribe, hit the notifications button. We've got a super special 2-part episode with episode 1 coming at the end of this week. So make sure to like, subscribe, visit us on the web. It's howtoinvestinCRE.com. And again, make sure those notifications are turned on. You don't want to miss the special episode coming up at the end of the week.
Thanks, guys.
Absolutely. Thanks.